Hello, everyone, and welcome to today's class on like-kind exchanges. We're going to begin by moving past the table of contents and on to the introduction, which begins on page 3 of the manual. And in certain situations, it is possible for a business to defer or delay taxation of capital gains and losses where an asset used for income production is traded for a similar asset also used for income production. IRS regulations require the deferral of gains and losses on the exchange of property that is like-kind. Now, normally when we have a discussion with a client about like-kind exchanges, we're hearing from the client because the client is looking for tax advice. They're trying to figure out how to get themselves into a qualifying like-kind exchange scenario. But it may be the case that they are in a like-kind exchange scenario and don't even know it, because there are some kinds of like-kind exchanges that are going on around us all the time, and as tax practitioners, we should be aware of what a like-kind exchange is so that we know when we see one, but also how to do the computations for the like-kind exchange. So we're going to look briefly at a summary of the rules here, and then we're going to go deeper into each of the rules. An exchange of property will be considered to be a like-kind exchange only if all rules applying to the like-kind exchanges are met. These rules are summarized as follows. Investment or income property only. In a like-kind exchange, both the property you give up and the property you receive must be held by you for investment or for productive use in your trade or business. Number 2, you must have qualifying property. In addition to being held for investment or business use, the property must be qualifying property. Certain types of non-qualifying property are not allowed in Section 1031 exchanges. Like-kind. Both the property given up and the property received must be like-kind. Rule number 4, there is a 45-day identification period. The property received must be identified within 45 days after the property given up in the exchange is transferred. And then there is a 180-day receipt rule. The property received must be received by the earlier of 180 days after the transfer of the property given up in an exchange, or the due date of the return, including extensions for the year the property given up is transferred. Rule number 6, boot is taxable. Any money or unlike-kind property received in the exchange is considered to be boot. Rule number 7, liabilities assumed by other party are considered to be boot. Liabilities transferred to the other party in an exchange in excess of liabilities assumed by the taxpayer are treated as boot. Like-kind exchange rules are mandatory. The gain or loss realized on the exchange of like-kind property must be deferred and is not recognized. Rule number 9, related party exchanges are subject to additional rules. A trade of like property between related parties is given like-kind exchange treatment, and if either party sells or disposes of the traded property within 2 years of the trade date, then the date of the subsequent sale means that on the date of the subsequent sale, it is deemed to be a disqualifying transaction, and both parties must recognize gain or loss on the sale, even though only one of them sold. Depreciation treatment. The MACRS depreciation method, convention, and placed in service date which applied to old property will continue to apply to any basis transferred to the new property. If the basis of the new property is greater than the basis of the old property, any additional amount added to basis will be depreciated beginning on the date the new property is acquired. Sale of home. You may not exclude gain on the sale of your home if you sell your home within 5 years of acquiring it in a like-kind exchange. And number 12, reporting. If you have a like-kind exchange, you need to report it on Form 8824. So we're going to take each of these 12 rules in turn now and dig into them to really gain an understanding of what each rule is talking about. And we're going to begin with rule number 1. In a like-kind exchange, both the property given up and the property received must be held by you for investment or business purposes. Examples of property that may qualify include machinery, buildings, land, trucks, and rental houses. But with respect to rental houses, the rental property must not have been used for more than 14 days of personal use. Qualifying property must not be used for personal use for more than 14 days per year, or 10% of the actual number of days the property has been rented in any given year. Also, replacement property cannot be purchased with the intent to immediately resell it. You cannot defer gain in a like-kind exchange if you intend to immediately sell it. You must acquire the property with the intent to hold it for use in your business or for investment purposes. So that's kind of an odd one. How long does my property need to be used for business in order to be qualifying property in a like-kind exchange? Well, the IRS gives no specific instructions on how long property must be held for investment or business use. However, a good guideline to follow is a minimum of 1 to 2 years. The burden of proof with regards to showing business or investment use falls to the taxpayer. There is no safe harbor holding period for complying with the held for requirement. The IRS will look to the apparent intent of the taxpayer. The IRS will determine intent by considering facts and circumstances surrounding a taxpayer's acquisition of ownership of property and what use the taxpayer makes of the property. IRS interpretation of intent tends to be more conservative than with the courts on these matters. So IRS interpretation of intent tends to be more conservative, where the courts may be more liberal. But the only way you're going to know what the court has to say is if the IRS gives you a hard time and you ultimately take it to court. So, for example, you own a rental property, and you decide that you want to trade it for another rental property. Thing is, the other rental property that you're exchanging for, you don't actually intend to hold it for rent. You intend to flip it. You intend to buy that property, fix it up, and sell it, never holding it for rent. The IRS would not deem that to be a like-kind exchange or a qualifying piece of property for a like-kind exchange, because the intent is not to trade one piece of business income production property for another piece of business income production property, but rather to reduce the basis on this house and that you ultimately really should be treating as an inventory item. So this is what these rules are about. So examples of transactions that might cause the IRS to question whether a property is held for business or investment use includes this example that I've already given you. The taxpayer acquires replacement property and then immediately lists that property for sale because the IRS is going to interpret that you really never intended to hold it for investment purposes. Or the taxpayer acquires replacement property and then immediately converts the property to a personal residence. So let's just suppose you have this rental house. You've been renting it for years, and you decide that you'd like to take the equity in that house and really roll it into another house that you'd rather live in. You've got this rental house that's worth money. If you sell it, you're going to have to pay tax on it. So can I get out of this by not selling it directly and instead doing a like-kind exchange and trading it for a house that I do want to live in? Well, IRS says if you trade it for a house that you do want to live in and then you move into it, that won't be a qualifying like-kind exchange either, because it was immediately converted to a personal residence. Or the taxpayer acquires replacement property and then immediately transfers that property to a corporation, partnership, or LLC. So that's rule number one. Where were we on rule number one? It has to be for income or investment purposes only. Rule number two. The relinquished property must be qualifying property. To qualify for tax deferral under the rules for like-kind exchanges, there must be a trade or exchange of qualifying property. Qualifying property is property held for investment purposes or used in a taxpayer's trade or business. Investment property generally includes real estate, whether it is improved or unimproved, that is held for investment or income-producing purposes. So although we tend to think of the like-kind exchange rules applying to assets that are held for rent, for example, or are depreciable assets used in a trade or business, it is sufficient in the case of real estate to show that a vacant lot is just being held for investment purposes, and that you can do a trade of a vacant lot for a commercial building or vice versa, and that would be considered like-kind. Qualifying property used in a trade or business can include farmland, office buildings, and real estate activities. Equipment used in a trade or business activity and Section 197 intangible assets such as copyrights, but not for goodwill and going concern value. Property which does not qualify for a Section 1031 exchange includes a personal residence, land under development for resale, construction or fix flips for resale, property purchased for resale, inventory property, corporation common stock, bonds, notes, partnership interests, goodwill, and going concern value. Rule number 3, the property exchanged must be like-kind. To qualify for like-kind exchange treatment, both the property given up and the property received must be like-kind as defined by the IRS. In addition, the property given and the property received must be qualifying property. So determining if the property given and the property received are like-kind is the next topic. To be allowable, the asset given and the asset received must be of like-kind or like class. Like-kind properties are properties of the same nature or character, even if they differ in grade or quality. Property must generally belong to the same asset class or the same product class. So let's talk about the general asset class. The general asset classes are found in the regulations and can be summarized as follows. Office, furniture, fixtures, and equipment all belong to the same asset class, which is 00.11. And in fact, you can see a listing of all of these general asset classes in the IRS publication for depreciation, publication 946. If you flip to the appendices at the back of that publication, you will see all of the various asset classes listed. And if you flip to asset class 00.11, you will see it includes office, furniture, fixtures, and equipment. And in publication 946, you will see that information systems such as computers and peripheral equipment belong to asset class 0012, and therefore a computer and its peripheral equipment are considered to be like-kind property. Data handling equipment, except computers, belong to asset class 0013. Airplanes, including airframes and engines, but excepting airplanes that are used in commercial or contract carrying of passengers or freight, and all helicopters, including airframes and engines, all belong to the same asset class 0021. Automobiles and taxis are in the same class, but buses are in a class all their own. Light general purpose trucks are in a different class than heavy general purpose trucks. Railroad cars and locomotives, except those owned by railroad transportation companies, are all in the same class. Tractor units for over-the-road use are in a different class than the trucks that would pull them. Tractor units for use over the road are a different class rather than the trailers they will be pulling. And vessels, barges, tugs, and similar water transportation equipment, except those used in marine construction, all belong to asset class 0028. And finally, industrial steam and electric generation or distribution systems all belong to the same class. Now, there's many, many more classes than what I have summarized here. You can find those listed again in the appendices for 946. Now, it may be the case that you have assets that are not specifically listed as belonging in the same class in publication 946, but it could be that they are still considered to be part of the same product class. And product classes include property listed in a 6-digit product class, except any ending in the digit 9. In sectors 31 through 33 of the North American Industry Classification System, or NAICS, of the Executive Office of the President of the Office of Management and Budget. And it can be accessed by this link I've got right here. If you want to read this riveting manual for yourself, you can click on the link that I have in the manual. You will see that it is a 2012 classification book, and it is updated every 5 years. So we would be looking at the next update to be in 2017. Let's look at an example here of how we have like class, we have the same product class or the same overall general asset class. In example number 1, Charlotte trades a personal computer used in her business for a printer to be used in her business. The properties are exchanged are within the same general asset class, which is 00.12, and they are therefore of a like class. She would have a qualifying like-kind exchange, therefore. Number 2, Wilbur transfers a grader with NAICS code 333120 to Ron in exchange for a scraper, which belongs to NAICS code 333120. They're both in the same product class. They're both used in a business. But neither property is within the same general asset class, and that doesn't matter because they are both in the same product class. And so what I have here is an excerpt of the NAICS code, and you will see that under 333120 we have graders, road equipment, manufacturing, as well as scrapers and construction type in manufacturing. And because Wilbur's grader and the scraper are both in the same general NAICS code category, they are considered to be in the same product class. And finally, we have taxpayer number 3. Taxpayer G transfers the following property to H: a personal computer in asset class 0012, an airplane in asset class 0021, and a sanding machine with NAICS code 333243. And you see I've listed that here in green. H transfers the following property to G in return: a printer that is in the asset class 0012, a car in asset class 0022, and a saw with an NAICS code of 33343. So what we can can see is that the saw and the sanding machine belong to the same product class, and therefore they are like kind. The personal computer and the printer belong to the same class, 0.12, and they are like kind. But the car with 0.22 and the airplane with 0.21 are not like kind. They are not in the same product class, nor they are in the same overall classification code, and therefore they are not eligible for the like-kind exchange treatment. Replacement property must be identified within 45 days, and this particular excerpt comes from IRS Publication 544. You must identify the property to be received within 45 days after the date you transfer the property given in the exchange. This period of time is called the identification period. Any property received during the identification period is considered to have been identified. If you transfer more than one property as a part of the same transaction and the properties are transferred on different dates, the identification period and the receipt period begin on the date of the earliest transfer. Identifying replacement property. You must identify the replacement property in a signed, written document and deliver it to the other person involved in the exchange. You must clearly describe the replacement property in the written document. The following are examples of acceptable descriptions: the legal description or street address for real property and the make, model, and year of a car. In the same manner, you can cancel an identification for replacement property at any time before the end of the identification period. Identifying alternative and multiple properties. You can identify more than one replacement property. Regardless of the number of properties you give up, the maximum number of replacement properties you can identify is the larger of the following: 3 properties regardless of their fair market value, or any number of properties whose total fair market value at the end of the identification period is not more than double the total fair market value on the date of transfer of all of the properties you give up. If, as of the end of the identification period, you have identified more properties than are permitted under this rule, the only property that will be considered identified is any replacement property you received before the end of the identification period, and any replacement property identified before the end of the identification period and received before the end of the receipt period, but only if the fair market value of the property given up is at least 95% of the total fair market value of all identified replacement properties. Fair market value is determined on the earlier of the date you received the property or the last date of the receipt period. So here is a summary of those replacement rules that I just rattled off at you. We have the 3-property rule, and under the 3-property rule, if the total number of properties you identified is 3, then there would be no limit on the value of the properties that you receive in exchange for the property you're given up. But if you decide to go the other direction and identify more than 3 properties, so long as the value of the property you receive is not more than 200% of the property you give up, then there's no limit on the total value of the properties that you can identify. Disregard incidental property. Do not treat property incidental to a larger item of property as separate from the larger item when you identify replacement property. Property is incidental if it meets both the following tests. It is typically transferred with the larger item, and the total fair market value of all of the incidental property is not more than 15% of the total fair market value of the larger item of property. Rule number 4, the replacement property must be received within 180 days. This also comes from IRS Publication 544. Gain or loss from a deferred exchange can qualify for non-recognition even if the replacement property is not in existence or is still being produced at the time you identify it as replacement property. Receipt requirement. The property must be received by the earlier of the following dates: 180 days after the date on which you transfer the property given up in the exchange, or the due date, including extensions for the tax year in which the transfer of the property occurs. Now, this is where we get into the use of qualified intermediaries and why these transfer dates and receipt dates are really so important. I mean, if you go out and you find a rental house that you'd like to buy, and you have a rental house that you'd like to sell, what are the odds that the owner of the house you're interested in buying wants your house in exchange? Pretty small. And that's why we really have these identification periods in here, because the odds are that you're not going to be doing a direct trade with the buyer of your property. Odds are, at least in the case of real estate, that you're going to be involving an intermediary. And the reason these rules are important is because when you use intermediaries, you have to be totally on top of the dates. There's the 45-day identification period and the 180-day receipt period. So let's talk about like-kind exchanges using qualified intermediaries. Exchange intermediaries make it possible to achieve a qualifying like-kind exchange in situations where a direct exchange between two interested parties is difficult or otherwise unlikely to occur. If you transfer property through a qualified intermediary, the transfer of the property given up and receipt of like-kind property is treated as an exchange. This rule applies even if you receive money or other property directly from a party to the transaction other than the qualifying intermediary. Now, you can Google 1031 exchange intermediaries. Just go to the internet, type that search engine, and you will quickly see that there are a number of organizations out there that hold themselves out as and specialize as being intermediaries. One of these companies, 1031cpas.com, provides a Form 8824 worksheet that can be helpful in completing Form 8824. And this is really almost a compliment on my part. You could say it is a compliment on my part. The IRS instructions for Form 8824 are awful. It's a long time ago now, probably 15 years ago. I was on the phone with the IRS discussing a like-kind exchange that I was helping a client with. And they were using a qualified intermediary, and I was confused about some of the information this intermediary was providing. Ultimately, I ended up talking to a number of different IRS agents, including a man who represented the IRS in tax court. He was giving me different information than the intermediary was giving me. So the intermediary seemed to be much more conservative. And since that time and all the years that have passed, I've never been able to find another IRS person who does anything other than agree with intermediaries. So the intermediaries seem to have a pretty good idea of what is going to be commonly accepted by the IRS. It's a very conservative approach, and their worksheets and so forth that they provide that can help you to fill out Form 8824 are very useful, but you should be aware that they are quite conservative. So a qualified intermediary is a person who enters into a written exchange agreement with you to acquire and transfer property you give up and to acquire the replacement property and then transfer it to you. This agreement must expressly limit your rights to receive, pledge, borrow, or otherwise obtain the benefits of money or other property that are held by the qualified intermediary. So let's just think about this. You've got the rental house that you want, you've got the rental house that you own, and you want to trade one for the other. You know for a fact that whoever is selling that house that you want, they're not going to want your house in exchange. So how do you make this work? What you do is you go to a qualified intermediary and you say, hey, qualified intermediary, I want you to buy that house that's for sale. And I want you to buy my house. And after you've bought my house from me, I want you to trade that house that you bought from the other party to me. So that qualified intermediary becomes the go-between that makes the like-kind exchange possible. Now, there are 4 different types of exchanges that are described on the qualified intermediary sites. You won't really see these so much in the IRS instructions, but you do find them commonly talked about by the intermediaries themselves. Exchange intermediaries describe 4 different types of exchanges that may be completed under like-kind exchange rules as follows. Firstly, we have the simultaneous exchange, and this is an exchange in which the closing of the relinquished property and the replacement property occur on the same day, usually back-to-back. There's no interval of time between the 2 closings. We then have something called a delayed exchange or a starker exchange. This is an exchange where the replacement property is closed on at a later date than the closing of the relinquished property. The exchange is not simultaneous or on the same day. This type of exchange is sometimes referred to as a starker exchange after the Supreme Court case which ruled in the taxpayer's favor for a delayed exchange before the Internal Revenue Code provided for such exchanges. We also have a reverse exchange, also called a title holding exchange. This is an exchange in which the replacement property is purchased and closed on before the relinquished property is sold. And finally, we have an improvement exchange or a title holding exchange. This is an exchange in which the taxpayer desires to acquire a property and arrange for construction of improvements on the property before it is received as replacement property. The improvements are usually a building on an unimproved lot, but also include enhancements to make an already improved property have higher value. So you can create that higher value at the time of the exchange with little or no boot occurring. Now, the rules do not permit a taxpayer to construct improvements on a property as part of a 1031 exchange after receiving title to the property as replacement property in that exchange. Therefore, it is necessary for the intermediary to close on, take title, and hold title to the property until the improvements are constructed, and then convey title of the improved property to the taxpayer as replacement property. And here is an example where we have an allowable exchange and things were done through the qualified intermediary so that it all comes together. Assume you own a duplex valued $1 million, which you decide you want to trade for vacant land costing $600,000. You want to build a fourplex on the vacant land at an additional cost of $600,000. Under the like-kind exchange rules, the money you put into building the fourplex will not be treated as a part of the exchange unless the fourplex is built prior to completion of the exchange. So you decide to work with the seller of the vacant land and the qualified intermediary to build the fourplex and then receive the land with the completed fourplex as a part of the trade. That would be an example of an improvement exchange that would qualify for like-kind exchange treatment. But let's look at example number 2 where we have a non-qualifying exchange. We're going to assume the same facts as in the previous example, except that you take possession of the vacant land and then invest $600,000 to build the fourplex after you take possession of the land. The subsequent building of the fourplex will not be treated as a part of the exchange, and what that really means is that if you own a duplex valued at $1 million and you trade it for vacant land costing $600,000, you're going to realize $400,000 of taxable boot in that transaction. Safe harbor method for reporting gain or loss when qualified intermediary defaults. Generally, if a qualified intermediary is unable to meet its contractual obligations to you or otherwise causes you to not meet the deadline for identifying or receiving replacement property in a deferred or reverse exchange, your transaction may not qualify as a tax-free exchange. In that case, any gain may be taxable in the current year. However, if a qualified intermediary defaults on its obligation to acquire and transfer replacement property because of bankruptcy or receivership proceedings, and you meet the requirements of Revenue Procedure 2010-14, you may be treated as not having actual or constructive receipt of the proceeds of the exchange in the year of the sale of the property you gave up. If you meet the requirements, you can report the gain in the year or years payments are received using the Safe Harbor Gross Profit Ratio method. And you can refer to that particular revenue procedure by clicking on the link here. So that's it for rule number 5 on those qualified intermediaries. Let's go on to rule number 6, because boot received is taxable, and your mind should at all times be concerned about, was there boot in this transaction? The term boot is not used in the Internal Revenue Code or the regulations, but it is commonly used in discussing the tax consequences of a 1031 tax-deferred exchange. Boot is an Old English term meaning something given in addition to. Boot received is the money or the fair market value of other property received by the taxpayer in the exchange. All of the following are considered to be boot: money, including all cash equivalents plus liabilities of the taxpayer that are assumed by the other party, and other property that is non-like kind, such as personal property received in exchange for real property used for personal purposes, or non-qualified property. Other property also includes such things as a promissory note received from a buyer, also known as seller financing. Now, the best way to avoid boot is always to trade up by receiving replacement property of equal or greater value than the relinquished property. Trading down occurs where the replacement property is of less value than the property giving up, and trading down will always result in boot received. And here is an example where we have boot that was received in an exchange. Joe operates a vintage car rental service, which rents vintage cars for use in photography, movie production, and entertainment events. During the year, he traded a vintage 1969 Corvette coupe with an adjusted basis of $40,000 for a vintage 1967 Z28 Camaro coupe valued at $90,000. In addition to the Camaro, he received $10,000 of cash in the transaction. The cash is considered to be boot. So ultimately, you don't see the word 100,000 or the number 100,000 appearing in here, but you can extrapolate that the Corvette had a fair market value of 100,000 because he's receiving the Camaro plus 10,000. And if the Camaro is worth 90 and they're willing to give you the Camaro plus 10,000, then your Corvette must be worth 100,000, right? So in this particular situation, that $10,000 of extra cash that you are receiving is boot, and it would be taxable. Partially non-taxable exchanges. If in addition to like-kind property, you also receive money or unlike property in exchange on which you realize a gain, then you will have a partially non-taxable exchange. So how do you go about figuring the taxable part of your exchange? You are taxed on the gain you realize, but only to the extent of the money and the fair market value of the unlike property you receive. Therefore, the recognized or taxable gain on the disposition of the like-kind property you give up is the smaller of two amounts. 1, the amount of gain realized, or 2, the limit of the recognized gain. You follow these steps to figure the limit on the recognized gain. Add the money you received plus the fair market value of any unlike property you received. Then reduce this amount, but not below zero, by any exchange commission or exchange expenses or closing costs that you paid. So compare that amount to your gain realized, and then your recognized or taxable gain is the smaller of the two. So to make sense of that, let's just continue with that illustration that I started earlier, back with the Corvette and the Camaro. Joe traded a 1969 Corvette for a 1969 Camaro. His adjusted basis in the Corvette is $40,000, and at the time of the trade, the Corvette had a fair market value of $100,000. In addition to receiving the Camaro, he received $10,000 of cash boot to finalize the transaction. He also paid registration fees and taxes for the Camaro in the amount of $5,000. The transaction results in $55,000 of realized gain for Joe. The gain is partially taxable as follows. We break the numbers down. $5,000 of taxable gain, $50,000 of deferred gain, and here's how we calculate them. You figure Joe's realized gain on the exchange of the Corvette as follows. We have the fair market value of the property received. He is receiving a Camaro valued at $90,000, and he's also receiving $10,000 of cash. So the total amount he's received is $100,000. But he's paid $5,000 of exchange expenses, so he subtracts those out to arrive at an amount realized of $95,000. From that, we subtract his adjusted basis in the Corvette, which is $40,000, to arrive at his realized gain of $55,000. Next, we figure the limit on the amount of gain that he will need to recognize. So his realized profit is $55,000, but he's not going to have to include $55,000 as income. He's only going to have to include as income the amount that is deemed to be boot. And in the end, the boot that he received of $10,000 is reduced by the exchange expenses he had to pay out. So one form of non-qualified property is offset by another form of non-qualified property, and so that leaves him with a recognized taxable gain of $5,000. Liabilities assumed by the other party are considered to be boot. Offset all liabilities you assume as a part of the exchange against all liabilities of which you are relieved. Offset these liabilities whether they are recourse or non-recourse, and regardless of whether they are secured by or otherwise relate to specific property transferred or received as a part of the exchange. So we saw in that earlier example that the $10,000 of cash received along with the Camaro is a form of boot. And the worry or concern whenever you're dealing with a like-kind exchange is determining how much boot was actually received, reducing that by any exchange expenses that you had, then paying tax on the resulting number. So the ticket is to avoid boot as much as possible, and here are the rules for avoiding boot. Always trade across or up. Never trade down. This is called the even or up rule. Trading down always results in boot received, either cash, debt reduction, or both. The boot received can be mitigated by exchange expenses that were paid. Bring cash to the closing of the relinquished property to cover charges which are not transaction costs. Do not receive property which is not like kind. Do not overfinance replacement property. Financing should be limited to the amount of money necessary to close on the replacement property, in addition to exchange funds which will be brought to the replacement property closing. For example, debt relief can be taxable. Returning to the earlier illustration, assume all of the same facts except that the Corvette that Joe traded was subject to an $8,000 note that the other party assumed. You're then going to figure the taxable gain for Joe as follows. Fair market value of the like-kind property, the Camaro, $90,000, which he received, along with $10,000 of cash, and then on top of that, $8,000 note was assumed on that Corvette. So that means that the total amount Joe is receiving in this trade is $108,000. He's going to subtract out that $5,000 of exchange expenses to arrive at an amount realized in the transaction of $103,000. He's going to subtract his cost basis in the Corvette by $40,000. That gives him a realized gain of $63,000. Limit of recognized gain, although the amount of gain Joe realizes in the sale in this second illustration is $63,000, the taxable part of his gain will be limited to the amount of unlike property he received minus his exchange expenses as follows. He received the $10,000 of cash. He also received $8,000 of debt assumed by the other party. He is going to offset those with the exchange expenses he paid, so the recognized gain will be $13,000. Rule number 8, these exchange rules are mandatory. You can't opt in or out of them. If you trade business or investment property for other business or investment property of a like kind, you do not pay tax on any gain or deduct any loss until you dispose of the property that you receive. If you sell property and buy property similar in two mutually dependent transactions, you may have to treat the sale and purchase as a single non-taxable exchange. And here we have an example, a like-kind rule where a sale is actually a trade. You used your car in your business for 2 years, and it has an adjusted basis of $3,500, and its trade-in value is $4,500. You are interested in a new car that costs $20,000. Ordinarily, you would trade your old car for the new one and pay the dealer $15,500. Your basis for depreciation of the new car would then be $19,000. That's the $15,500 plus the $3,500 of adjusted basis in the old car. But you want your new car to have a larger basis so that you can claim a bigger depreciation deduction. So you'd arrange to sell the old car to the dealer for $4,500, and then you turn around and buy a new one from that same dealer for $20,000. However, in that situation, you would be treated as having exchanged your old car for the new one because the sale and purchase are reciprocal and mutually dependent. Your basis for depreciation in the new car will be limited to $19,000, and it is the same as if you just traded it in the first place. Rule number 9, related party exchanges are subject to additional rules, and this comes again from IRS Publication 544. Special rules apply to like-kind exchanges between related persons. These rules affect both direct and indirect exchanges. Under these rules, if either person disposes of the property within 2 years after the exchange is disqualified from non-recognition treatment. The gain or loss on the original exchange must be recognized as of the date of the later disposition. Related person. Under these rules, a related person includes you and members of your family, such as your spouse, brother, sister, parent, etc., or a corporation in which you have 50% ownership, or more than 50% ownership, or a partnership in which you directly or indirectly own more than 50% of the interest in the capital or profits, and 2 partnerships in which you directly or indirectly own more than 50% of the capital, interest, or profits. The following kinds of property dispositions are excluded, however, from these rules. These include dispositions due to death of either related person, involuntary conversions, or dispositions if it is established to the satisfaction of the IRS that neither the exchange nor the disposition had as a main purpose the avoidance of federal income tax. Rule number 10, MACRS depreciation of transferred basis from old property continues under the new property. The IRS became aware of inconsistent depreciation treatment by taxpayers of property that has a basis determined under Section 1031 or Section 1033. Certain taxpayers were depreciating the replacement property using the same depreciation method, recovery period, and convention as the exchanged or involuntarily converted property, while other taxpayers were depreciating the replacement property as if it were newly placed in service. In response, the IRS and the Treasury back in 2001 issued a Notice 2004, and it provides instructions on how to depreciate MACRS property that has a basis determined under Section 1031 or 1033. Also known as replacement MACRS property, provided that the exchanged or involuntary converted property was also MACRS property. The notice stated that replacement MACRS property placed in service after June 3, 2000 is depreciated over the remaining recovery period of and using the same depreciation method and convention as the relinquished MACRS property, and that any excess of the basis in the replacement MACRS property over the adjusted basis of the relinquished MACRS property is treated as newly purchased MACRS property. So just to kind of make quick sense of that, I don't really have an illustration in here, but I'm going to do one real quick for you because it's I think it's fairly simple to explain. So I'm just going to do that. Let's just suppose you have a car with a basis of $10,000 and you trade it for a new car with a fair market value of $50,000, which means you're actually delivering boot to the table. You're going to bring $40,000 to the table. So in this case, you're not receiving boot, you're paying boot out. The amount that you've paid for the new car is a total of $50,000. And in terms of the basis of the old car, it doesn't really matter how much trade-in. In this case, the trade-in value they're giving you is the same as your basis. It could be, I'll give you a better example, that you only have to bring $30,000. That's a better example. So you trade in a car with a basis of $10,000 for a car with a fair market value of $50,000, and then you need to bring boot to the table in the amount of $30,000. What that's telling you is that you have a built-in gain in the old car of $10,000 because they're giving you a $20,000 trade-in even though your basis is only $10,000. So here we have an actual situation where there would be a gain. But you're not going to include that gain in income. Instead, you're going to have to do a Form 8824. This is a mandatory rule. It's not like you can opt yourself out of it. The next issue is what is going to be your depreciation line? Well, your depreciation is going to be that the original basis of the car is going to continue at whatever depreciation amount has already been claimed on it. So on the depreciation schedule for the old car, you're going to leave that line in there and continue to depreciate the basis of the old car. And then the new car is going to create a new depreciation line on the return. And so that new line would have a cost basis of $30,000, and since this is a car, it would be depreciated over a period of 5 years. All right, rule number 11, sale of home. Additional rules apply to the sale of home if the home is acquired in a like-kind exchange. If you sell your home, which was acquired in a like-kind exchange, you cannot claim the $250,000 or the $500,000 married filing joint exclusion if you sell the home within 5 years from the due date that you acquired the home in a like-kind exchange. This rule also applies if you received the home as a gift from another person who acquired the home in a like-kind exchange. So let's take a look at the final rule, which is the one we're actually going to spend a little bit of time on, because the rules say you have to complete Form 8824 to report the exchange of like-kind assets. And the form itself is probably where I have some of my biggest complaints, because the IRS instructions for completing the form are just terrible, and you're left scratching your head trying to figure out what it's supposed to look like. Pretty hard to get your software to fill the form out correctly if you don't know what the finished form is supposed to look like. And ultimately, that's why I've got a pretty detailed illustration here to show you how it all breaks down. You can see that we are dealing with a multi-part form. Part 1 is used to report information on the like-kind exchange. Part 2 is used to report related party information. And then in Part 3, you figure the realized gain, the recognized gain, and the basis of the like-kind property received. And then in Part 4, the deferral of gain from Section 1043 conflict of interest sales. So let's talk about these parts in a little more detail. On lines 1 and 2, for real estate exchanges, provide the property address and the type of property, and for personal property, just enter a description. On line 5, the written agreement identifying replacement property must be signed by all parties to the agreement not later than 45 days after the transfer of property given up in the exchange. So on line 5, you enter the date that you identified the property you are to receive. Then on line 6, the replacement property must be received by the earlier of 180 days after the date the old property was transferred or the due date of the return, including extensions for the year the old property was given up. And you would enter the date that you actually received the property. On lines 7 through 11, a related party includes your spouse, child, grandparent, parent, stepbrother, brother, sister, or a related corporation, S-corporation, partnership, trust, or an estate. An indirect exchange with a related party includes an exchange made through an intermediary or an exchange made by a disregarded entity, such as a single-member LLC, if you are a related party that owned that entity. An exchange between related parties will generally qualify for non-recognition treatment if the property or properties which are exchanged are held for 2 years or more by the related properties. A disposition of any kind within 2 years of either of the related parties causes the deferred income to become taxable in the year of that second disposition. We move on to the next page, which is the page where we typically do all of our computations and where it can get confusing. So I'm going to show you an illustration in a minute. But let's talk about these lines first. On line 12, you're going to enter the fair market value of the other property that was given up in the exchange. And on line 13, you're going to enter the adjusted basis of the property you gave up. The 1031 Corporation website provides an 8824 worksheet which identifies other property as including principal and interest payoff and property tax proration. The IRS instructions don't provide any similar type of description, but I'm going to take us to that website. If you just give me a minute, I wanted you to see this particular worksheet because I think it's pretty darn cool. And if you are doing a like-kind exchange and you're having difficulty figuring out what numbers to enter on line 12, 13, 15, 18, this worksheet really helps guide you in the right directions. So I'm just going to share my computer screen here and take you to the internet. This is the URL I'm looking for. And when we go into this particular website, they have a lot of really helpful information. If you want to read a whole bunch more on like-kind exchanges, they have a great deal of information on their site, including, for example, rules for boot, aircraft exchanges, really a lot of useful information. But what I liked most when I found on their site was the Form 8824. Because when you go to the form, you can see here that they are also saying that there are no specific instructions provided by the regulations on how to fill out this form. But they've pretty much gone through and deduced through their years of work in here that these are the instructions you should follow. And if you click on this link for the worksheet, you'll end up downloading an Excel-type document. And when you open up that document, you'll see what I have in front of me here. It is a worksheet. And when you fill in the blanks that you have on the worksheet, it starts to carry those numbers that you enter to other lines, and finally it directs you on how to enter those onto the Form 8824. So I'm not going to spend any time really beyond this showing you the worksheet, but you can see that if you make entries on this particular screen, they're going to carry totals onto a mock-up of the form, and this will help you make sure that you are getting numbers where they need to be. And you can see they have a category here for loan acquisition costs, prepaid investment costs, etc. So now that I've shown you that, let's go back to the manual, and I'm going to actually show you an illustration in just a moment of how we complete Form 8824. And then finally, moving on down this form, we get to line 15, which is cash received, fair market value of other property received, plus net liabilities assumed by the other party, reduced but not below zero by any exchange expenses that you incurred. On line 15, you will include the sum of any cash paid to you by the other party, the fair market value of other not like-kind property that you received, if any, and the net liability assumed by the other party that is more than the total of any liabilities that you assumed, cash you paid to the other party, and the fair market value of other not like-kind property that you gave up. Reduce the sum of the above amounts, but not below zero by any exchanges that you incurred. And then finally, we have line 18, adjusted basis of the like-kind property that you gave up, net amounts paid to the other party, plus any exchange expenses not used on line 15. On this line, you will enter the adjusted basis of the property you gave up, exchange expenses, if any, except those that are used to reduce the amount on line 15, the net amount paid to the other party, the excess, if any, of the total of any liabilities you assumed, the cash you paid for the other party, and the fair market value of other not like-kind property that you gave up over any liabilities that are assumed by the other party. Now, the instructions for line 18 provide an example of the treatment of other property, but in referring to the instructions or the example provided, it should be noticed that that example shows a situation where each party to the transaction assumes the loan of the other party, and there is no reference provided in those instructions for independent financing through a third-party mortgage company, which is going to be the far more common situation. So let's look at this detailed illustration of how to complete Form 8824. During the year, Josie Wales traded his commercial building for an apartment building in a like-kind exchange using a qualified intermediary. You're going to use the following information to prepare Josie's Form 8824. For the commercial property, which is the property he gave up, he has an acquisition date of 10/1 of 2003. He sells that building for $900,000 and paid at closing costs of $10,000 plus agent commissions of $54,000. His original cost of purchasing the property was $300,000, and he has accumulated depreciation of $700,000 on the property. At the time he sold the property, he had a mortgage owed on the old property of $150,000, and the date transferred in the exchange is 10/1 of 14. Now he's trading that commercial building for an apartment building, and the date he identified that apartment building is 6/25 of 14. The purchase price is $1 million, and he paid another $12,000 in closing costs. He also had to bring cash down payment for the new building in the amount of $10,000, and then he took out a mortgage on the new building of $316,000. When completing Form 8824, you're going to need to assume the following. The closing costs for the sale of the commercial building and the purchase of the apartment building will be paid from the cash down payment and the new mortgage. The old mortgage is paid off by the proceeds from the new mortgage. So we have the adjusted basis of the commercial building, $300,000 minus $70,000 of depreciation. That gives us adjusted basis of $230,000. The next computation we need to work on is the additional money that he borrowed. The original loan is $150,000. The new loan is $316,000. So the difference between those two loan amounts is $166,000 of additional money borrowed. Next, we look at the basis of the apartment building. The adjusted basis of the commercial building is going to be the starting point. You take $230,000 of adjusted basis on the commercial building. You're going to add in the additional cash paid of $10,000 plus the additional money borrowed of $166,000 to arrive at an adjusted basis in the apartment of $406,000. So this is the number that we want to see appearing on line 18 of Form 8824. We then move on to the realized gain on the commercial building. The sales price is $900,000 minus the adjusted basis of $230,000 minus the closing costs of $10,000 and minus the agent commission fees paid of $54,000. And that leaves us with a gain on the sale of $606,000. But all of that gain is going to be deferred. None of it's going to be taxable. $606,000 gets entered on line 19 of 8824. And then finally, we have the fair market value of the property Josie received. That's the purchase price of the apartment, $1 million, plus the closing costs on purchase of $12,000. The fair market value of the property received is therefore $1,012,000. So let's go over to Form 8824, Part 1. And in Part 1, we describe the property given up and the property received. We provide the date that the property was originally required, the date that you actually transferred your property to the other party, the date that the like-kind property received was identified, and then the date you finally closed on the new property. Not a related party exchange, so we skip Part 2 and move on to the meat of the form, which is on page 2. On line 16, we enter the fair market value of the like-kind property that Josie received. We begin by entering the purchase price of the apartment and add in the closing costs that he had to pay. That's $1.12 million total. Then on line 18, we enter the basis of the like-kind property he gave up. That's the adjusted basis in the commercial building, added to the extra cash down payment that he made, added to the extra money financing he borrowed. $406,000 is the amount on line 18. We subtract line 18 from line 17, and we get $606,000. This is his realized gain or profit on the sale of the commercial building, but he will not have to pay tax on that. Instead, this realized gain reduces his basis in the new property, and therefore his basis for depreciation as well as any future sales of the new apartment building is going to be $406,000. So that concludes today's class on like-kind exchanges. I hope you found it worthwhile and helpful. And there is a homework assignment with today's class. If you're a self-paced student, you should take the time to go through and prepare this assignment. You will need to as part of the course requirements. But if you're a webcast student or a webinar student, you may still find it helpful to go to the LMS and print the answer key out for this particular assignment because it involves one of the more common types of like-kind exchanges, and that is that you go to the car dealership and trade in an old car for a new car, and whammo, certain situations that could create a like-kind exchange. In this story here, we have Ben Cartwright, who traded in his 2001 Chevy pickup for a 2014 GMC pickup at the Ponderosa GMC. Ben originally purchased his pickup in 2011 for $25,000. He has accumulated depreciation of $10,000. The dealer has allowed Ben a $20,000 trade-in allowance for the old pickup, and Ben will finance $20,000 in full consideration for the GMC. Prepare his Form 8824. So after this class is over, if you want to go to the LMS and visit this tab right here, the Materials tab, there will be an answer key for this homework assignment in there. If you're a webcast student, you can just go access it. If you are a self-paced student, you actually need to fill out the form and attempt the assignment before you will be given access to the answer key. So that concludes today's class, and thanks for participating. Password number 1 is Paladin, P-A-L-A-D-I-N, Paladin. We hope you've enjoyed this tax education class. Pacific Northwest Tax School is approved as a CE provider by the IRS and the states of Oregon, New York, and Texas. We have been awarded the Quality Assurance Standard by NASBA and meet the CE requirements for CPAs in most U.S. states and territories. Tax clients demand knowledge and experience. Pacific Northwest Tax School provides the in-depth, practical education needed to improve your understanding of tax law and to meet the demands of the competitive tax preparation industry.